Inflation is quietly one of the most powerful forces in currency markets. And if you trade Forex without understanding it, you are trading blind. Here is the core idea. Inflation measures how fast prices rise in an economy. When prices rise quickly, each unit of that country's currency buys less than it did before. On a global scale, that loss of purchasing power shows up in the exchange rate. A currency from a high inflation economy tends to weaken against a currency from a low inflation one. Investors and institutions prefer to hold currencies that hold their value, so capital moves away from economies where inflation is running hot. Now, the reason inflation matters so much to Forex traders is not just the inflation number itself. It is what inflation forces central banks to do. When inflation climbs too high, central banks raise interest rates to cool the economy down. Higher rates attract foreign investment because investors can earn better returns on assets held in that currency. More demand for the currency pushes its price up. When inflation is low and a central bank cuts rates to stimulate growth, the opposite happens. The currency tends to weaken as those returns become less attractive. This cycle, inflation rises, central bank raises rates, currency strengthens, is one of the most important patterns in Forex. A surprise rate hike after stronger than expected inflation data can move a currency pair sharply in minutes. So which numbers should you be watching? The Consumer Price Index, or CPI, is the most widely followed. It tracks the average change in prices paid by consumers over time. The Producer Price Index, or PPI, measures price changes from the seller's side and can signal future consumer price increases. For traders focused on the US dollar, the Personal Consumption Expenditures measure, known as PCE, is especially important because it is the Federal Reserve's preferred inflation gauge. Core inflation strips out food and energy prices, which can be volatile, to give a cleaner read on underlying trends. These reports are published on a schedule. An economic calendar tells you exactly when they are due. Knowing that a CPI release is coming on Tuesday lets you prepare instead of react. Here is what this looks like in practice. Say US inflation is running above target while Eurozone inflation is stable. A trader might look for opportunities to buy the dollar against the euro, especially if the Federal Reserve is signaling rate hikes. The biggest short-term moves often come not from the data itself, but from the gap between what the market expected and what the number actually showed. Trading around economic data carries real risk. Moves can be fast and sharp. Only ever risk what you can genuinely afford to lose. Track the next CPI release on an economic calendar and watch how your currency pair reacts when the number hits. That habit alone will sharpen your market awareness faster than almost anything else.